I want to use question 24 to look at inter-entity transactions between an investor and an associate to see what the effect of that is on the calculation of the investor's share of the associate's profit and loss. In this question, the investor is not preparing consolidated financial statements. Now, before we start to look at the different transactions that we need to consider, what is the implications of an investor not preparing consolidated financial statements? And the reason why we need to understand what the effect of that is because the entries that we'll pass under the two different scenarios, so where the investor does prepare consolidated financial statements or where they don't, differs slightly. This basically relates to the treatment of the results of the associate since acquisition date until the beginning of the current year, as well as the treatment of dividend payments or dividends that have been declared. Now, if the company, the investor does prepare consolidated financial statements, so there's a group structure, it means that the journal entries relating to the investment in associate is not passed in the accounting records of the investor, but only included on the consolidation worksheet. And because the entries on the consolidation worksheet are not permanent entries in the accounting records of the individual companies, it means that we need to adjust year after year for our share of the associates' earnings since the acquisition date. Whereas if the investor does not prepare consolidated financial entries, the entries regarding to our transactions with the associate and our investment in the associate, those entries are passed directly in the investor's account, and therefore we will only deal with the current year's transactions or the effect of prior transactions on the current year results, and we don't need to adjust for the period since acquisition up to the beginning of the current financial year because it's already incorporated in the results of the investor. Now, if we just briefly look at the information that was given in this question, once again, I'm using a timeline to plot when the transactions happen so that we know which of the transactions do we need to take into consideration, if it's prior year entries, whether it still affects the current year, and it makes it just easier to basically deal with the information in the question. Now, they told us that the investor owns 25% of one of their associates. There were no differences between the fair values and the carrying amounts of the identifiable assets and liabilities of the associate on the date of acquisition. So it means we don't need to do the acquisition analysis, as there won't be any goodwill or excess income that needs to be taken into consideration. For the current financial year, the associate recorded a profit of $100,000. During this current financial year, they've also paid a dividend of $10,000. This dividend was declared in June 2012, as well as an interim dividend of $8,000. Okay, so this is what I've noted here as the two dividend payments. And once we've looked at the four transactions that occurred since acquisition date, we'll be able to move on to the calculation where we calculate our share of the associate's profit or loss for the current year. Now, there basically happened four transactions, and I'm going to look at each of them individually. Now, you know by now that when we calculate the investor's share of the associate's profit or loss, we need to adjust for any unrealized profit resulting from transactions between the investor and the associate. they are categorized as unrealized profit because it didn't result from transactions with external parties, parties that are external to this business association relationship, if I can call it that. And we want to report only the profits that were generated from transactions with external parties. So similar to the principles that we apply in consolidation, where we eliminate any inter-group transaction, the profits on those transactions, with an investor-associate relationship, we also want to eliminate those unrealized profit resulting from transactions between the investor and the associate. Okay, so the first transaction that occurred since we made the investment in the associates is that on the 1st of July 2011, so that's this entry, Mandolin, who is the associate, sold a non-current asset that cost $10,000 to Piano Limited, who's the investor, for $12,000. So you can see there is a $2,000 unrealized profit that resulted from that transaction. This relates to the previous financial period. So in the previous financial year, we would have adjusted for that full unrealized profit on this transaction. And then as we depreciate this non-current asset at 10% per annum, we're going to realize that profit. So basically, as we use that asset, and the usage of the asset is reflected in the depreciation rate. So as we use that asset, we're going to recognize the unrealized profit. Now, profit can realize in two ways. First of all, if we sell that asset to an external party, it's going to be a realized profit. But if we use that asset in our business to generate sales revenue by using that asset, the usage of the asset and the depreciation rate also reflects, also used then to realize that profit. So it's not necessarily that the asset has to be sold to an external party, but the mere fact that we use it in our business to generate sales revenue, it's also an indication that we are realizing that profit on the sales transaction between the two entities. So every year until the asset is used up, that's 10 years, there will be a realized profit that will be included in our calculation of $200. But because we work with the profit figure of after tax, it's going to be an after tax an amount of $140. The second transaction that they gave us information on occurred on the 1st of January 2013. So you can see that is in the current financial year. Mandolin Limited, so the associate, sold an item of plant to Piano for $15,000. So that was the selling price in the transaction. The carrying amount at that stage was $12,000. And the investor, Piano Limited, is depreciating that plant item at 15% per annum. So you can see in this scenario that we have an unrealized profit of $3,000. So we'll first of all have to make an adjustment for the unrealized profit. So that would be $3,000 after tax. But then also, because there's a 6-month time frame since the this plant item was sold between the two entities, there's usage of that plant item for 6 months. So the unrealized profit, there will be a section of that that's actually realized during the year. So 15% of the 3,000 for half a year, and of course that also has to be after tax. So just running out of space there. Okay, so that was the second transaction.